Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Wealth Services, and today I'd like to highlight our second quarter market review and investment outlook report. In our first quarter Huddle newsletter investment report entitled AI Rise of the Markets, we stated that the stock market was pricing in only the positive aspects of artificial intelligence while ignoring any possible future negative ramifications. That trend extended to the second quarter, with many AI-related stocks, led by graphic chips provider NVIDIA, continuing to climb and serving as the driving force behind the S&P 500's 4% gain for the period. We think strong gains for technology stocks have been fueled by a focus on AI and investors' preference for high-quality stocks given economic and market uncertainty. According to LSEG DataStream data, the tech sector is up 30% this year, nearly 4 times higher than the rest of the S&P 500. AI has helped drive that outperformance by enhancing corporate earnings for tech firms. Analysts expect tech earnings to rise 20% in the next 12 months, well above forecasts for the rest of the market. Strong balance sheets are also a plus for technology companies, and many top tech names are highly profitable and cash flush, allowing them to fund the build-out of AI infrastructure, such as data centers. So what could halt the climb in tech stocks? Markets could lose favor for the sector if hopes for AI are dampened, such as if they feel the corporate spending on AI hasn't paid off in a boost to earnings or margins. Any regulatory changes limiting adoption could also affect AI's potential to keep supporting tech stocks. In a less likely scenario, other sectors could jump ahead of tech if economic growth accelerates and inflation falls enough to allow the Federal Reserve to cut interest rates more than expected. Regarding the overall investment environment, we're focused on the stability of the market's three-legged investment stool. Those legs are inflation, interest rates, and corporate earnings, and their relative changes impact the overall health of the stock and bond markets. Looking at inflation trends in the second quarter, both the Consumer Price Index and the Federal Reserve's favorite inflation gauge, the Core Personal Consumption Expenditures, or PCE Index, reported improved results in the quarter. Encouragingly, despite the first quarter rise in the 3-month rate of the core PCE, April and May data showed marked improvement. The year-over-year rate through May declined to a multi-year low of 2.6%. We continue to monitor inflation very closely, as market expectations are for persistent easing in inflation trends, which then contributes to moderating interest rates and ongoing support for stock and bond prices. Aided by reduced inflation fears, the 10-year U.S. Treasury bond yields peaked in late April at 4.7% and have dropped back to under 4.5%, helping bond prices rise and providing less competition for stocks. 2-year Treasury note yields also peaked in late April at a rate of 5% and are now yielding under 4.8%. Generally, the 2-year Treasury yield is a harbinger of future Fed funds rates over the next 2 years, which would imply a drop in the Fed funds rate of approximately 50 to 75 basis points. The CME FedWatch tool now predicts the first Fed funds rate cut in September, which bodes well for stock prices headed into the final quarter of the year. On the earnings front, the total S&P 500 earnings for the second quarter of 2024 are expected to be up 8% from the same period last year on 5% higher revenues. This follows the 7% earnings growth on 4% higher revenues in the first quarter. Positive earnings revisions for the S&P are being driven by improving profit margins. Helped by technology companies, consensus margin numbers are projected to increase each of the next 3 years. Looking at the calendar year picture, total S&P 500 earnings are expected to grow by 9% this year, with projections of nearly 14% growth in 2025. Next year's earnings are also projected to be strong for small cap and international stocks. Taken together, the 3 legs of the market's investment stool are on firmer ground than they were 2 months ago, and serve to support our positive thesis on the direction of stock and bond prices. While longer-term interest rates may remain elevated due to low unemployment and positive GDP data, slowing inflation is likely to allow the Federal Reserve to cut the Fed funds rate in the fall. Additionally, positive earnings projections may provide fuel for higher stock prices by the end of 2024. Thank you for watching today, and please read our full market review and investment outlook report for greater detail on the second quarter and our forecast for the rest of 2024. Take care, and we'll see you next time.